here. And I think we are recording. So I'll go ahead and get started. First off, thank you guys for being here. I appreciate it. And today we're going to be doing Investment Financing 101. So showing you guys a little bit of what's out there and make sure that you guys have some information so that as you guys are going out to do your first investment, you know what's available, you know what questions to ask, and you know some of the guidelines and kind of the ballparks you need to be in order to qualify for some of these loans. So first off, I want to thank the Buy It, Rent It, Profit platform, which is what we're on and where we're doing this webinar here today. This platform is for investors, and it's for investors who already have investment properties, for investors who are looking to do their first investment. It's a learning platform, it's an analysis platform, it's a community platform. It's all of those things geared towards investors. So if you have not checked out the Buy It, Rent It, Profit platform, definitely go sign up. It is also free thanks to their sponsors, the Tampa Housing Authority, Stewart Title, and Ed Klopif School. Karen, correct me if I pronounced that wrong.
Yep,
I'm sorry.
Ed Klopfer Schools of Real Estate and Utility Ranger with Tiffany Middle.
Yes, thank you.
Yeah.
So definitely check out the platform. Again, it is totally free at this point in time. So go ahead, sign up and utilize the resources here. Again, great for those who are looking to get into the investment world and those who are already in it, whether you have, you're looking to do your first or you already have 10 properties. This is a great platform for you guys. Also, there are other classes on here. So if you're looking to do other classes on real estate law, if you're looking to do a class on how to analyze deals, leadership, those classes are also being hosted on this platform. So check out those other classes as well. My name is Kay Sarah. I am a mortgage loan originator. I am with Motto Mortgage, and we're with the HomeWise branch. There are a number of Motto Mortgages, but we are the one that has an office in Winter Haven, Florida. So reach out to us. We are a wholesale mortgage brokerage, meaning we have lots of options, whether you're looking for investment or whether you're looking for your primary residence as well. As far as me, I come from an educator background. I was an instructor at after school math and reading program, working with kids who were behind, working with kids who were ahead, helping them get to that next level. And that's been my whole career, is helping people get to their next level. And that's what I'm looking to do here today. Help you get to your next goal, your next investment, your next real estate investment goal, through making sure that you guys have accurate and updated information. Just want to say this at the beginning, just in case someone's not able to stay till the end. I am available for free consultations, and you do not have to be ready to purchase in order to call me, okay? In order to call me and ask me questions and get information, you do not have to be ready, today to purchase. I'm here for information, and then I'm here throughout the process until we get you financed and closed on your property. So I'm going to go ahead and share my screen. And while I'm doing that, it looks like we had someone else join in, Ronald. Just a quick question. I already asked this to some of our other guests. Do you currently have investment property, or are you looking to do your first investment property? Right. So here we go. I have the screen shared with you guys. If you look below, you will see my phone number. You can text me or email me at that number. You can call me or text me at that number. Email will not go through, but you'll have my email at the end there. And again, looking to help anyone again at any stage. So let's go ahead and jump in. The first thing I want to share with you guys is the difference between retail and wholesale. We are a wholesale mortgage brokerage. And really the difference is, if you're going to retail, think about going to the bank. They're going to be your direct lender. So you go to the bank, you talk to them. They're only going to share the options that they have. They're only going to tell you whether you qualify for the loans that they offer. Whereas if you're coming to myself or someone on our Motto Mortgage team, we are able to analyze what you qualify for based on multiple lenders, okay? We have multiple lenders, both for the, if you're looking for your primary residence and if you're looking for investments. So we're able to really look at your financial situation and find the lender that's going to offer you the best rate, the best terms, and be compatible with the type of property or the strategy that you're going with. So again, we have access to a number of different lenders. We're able to analyze that for you. It's one application, so you're not doing a bunch of applications with a bunch of different banks or lenders when you come to us. We're going to take one application and we're going to see which one is going to be best for you. The other thing is going to be availability. Real estate does not happen 9 to 5. Especially in the investment world, sometimes we have to actually move really quickly in order to make sure that we can make sure that deal is going to go through for you. A lot of banks will need that. They will need a full 30, 45 days, depending on the type of loan, even more, in order to get you closed. We are able to get you closed quickly and as little as 2 weeks. Okay, so we are able to get those loans through. Again, it does depend on your situation. It does depend on your finances and the type of property that we are looking at, but we're able to move a lot quicker than those banks are so that we can get your deal closed, because especially in the investment world, you might be competing with, someone who's able to, do cash. So being able to close faster is going to be a big asset. And again, being able to access us, not just 9 to 5, Saturday, Sunday, call me. That's what we're here to do. That's the difference that we provide. The other thing is going to be, we're going to be able to pivot. So in the investment world, things do change. As much as possible, we want to know exactly what the situation is going to be before we start your loan. But that is not always the case. Sometimes an appraisal comes in low, something's seen on the inspection, and we need to pivot. And sometimes that might mean, hey, the original lender that we thought was going to be best for you, maybe there's another lender that's actually better for this situation. Maybe we hit, we hit a threshold in terms of price, or that, another lender might be better. We're able to actually pivot without you going to do another application. So we're able to do that for you. We're able to do that throughout your portfolio. So if you're buying multiple properties and we're using different strategies for different properties, we are able to be your one-stop shop. Again, as opposed to you having this lender that's really good with fix and flip and this lender that's really good with DSCR loans, you can just come to us and we'll make sure that at all times we're going to the best lender. And sometimes those lenders change month to month in the same situation. I can have the same application, and then 1 month we have one lender that's going to be the best, and the next month we have a different lender that is going to be the best option. So those are some of the benefits of going with a wholesale mortgage brokerage like Motto Mortgage HomeWise and our team here. So jumping into the information part of, learning about the different types of investment loans. There are two main buckets of loans. You're going to have your qualified mortgage and you're going to have your non-qualified mortgage. The easiest way to think about these two things is your qualified mortgage is backed by the government. Your non-qualified mortgage is not. So your qualified mortgage is going to have more stringent set rules, regulations, things that are put in place to protect the consumer, put in place to make sure that the loans are going to be sellable to the government. Whereas non-QM loans, the rules are more based on what the bank and the bank's investors are interested in. So there's going to be a wider range of criteria for approval. There's going to be a wider range of things that they may or may not want to see and look at. Again, which is one of the benefits of going with someone like us, because we're able to help navigate that for you and figure out which way is going to be the best. So with these government-backed loans, those government-backed loans, you're looking at FHA, VA, conventional loans, USDA loans. A lot of times people don't think about these loans as investment loans, but they can be. Now, the only thing with these loans, one of the biggest downsides to them in terms of investment loans is that you do have to live in the property for a minimum of a year, okay? So if you are looking to live in the property for a year, this could be a great option. And that's whether it's a single family or a quadplex. These loans can go all the way up to 4 units, government-backed loans. The other thing that's going to be good about these government-backed loans is going to be lower down payments. So with the FHA loan, as little as 3.5% down. If you're a veteran, this is an awesome loan, and I definitely recommend veterans maximize their VA loans just because there are so many benefits to them. As much as, as little as 0 down. So again, with these loans, caveat is you do have to live in the property, but the benefit is you have a lower down payment and typically also a lower interest rate as well, because it is being backed by the government. With these loans, you are being qualified based on your income. And this is one of the things that this is one of the reasons that we have these other types of loans that we're going to talk about next, because sometimes if you are a business owner, if you're 1099, even if you're an hourly employee, it can be hard to qualify for these government-backed loans because we need to show at least 2 years of income if you're not a salaried employee. And so that's going to be the other thing. We're going to be judging whether you qualify for this loan based on your income, based on your debt to income ratio. So how much debt is showing up on your credit report in comparison to your income. And then we'll also be looking at, of course, your credit score. And then you will have to have and show funds in order to be able to close and do the down payment. Any questions on using government-backed loans for investments? Again, house hacking, or if you plan on living in a property. One of the things that I did is I actually brought my house knowing that I wasn't going to live in it forever. So, was strategic about the house that I brought so that I would be able to rent it out later. So any questions about government-backed loans? I know these are ones that people are most familiar with, but any questions? Okay. All right, so now we're going to go into DSCR. DSCR is the first non-QM loan that we're going to talk about. And this is the most popular investment loan that we do. It's the one that we see most. And the reason is because it does not go based on your income. It's really focused on the cash flow of the property. So for this loan, you are very much focused on, is the property going to bring in more rent than what you are going to be paying out for the property? So your principal, your interest, your taxes, your insurance, your association dues. Okay, so we take all of those costs and we look to see, is the rent going to be equal or more than that amount? Okay. So with these loans, we do not ask for your income. We do not ask for your taxes. We're not going to call your employer. We are going to look at your credit score. So that's going to be a huge part of this, is going to be your credit score. We are also going to look at your experience. So if you are an investor that already has an investment property, it makes it easier for us to do DSCR loans, even though we do have options for those who are first-time investors and even for those who are first-time home buyers. There are less options for those, but we do have those. We do have those available. So credit score for this loan, in order to open up the options, we want about a 680. And in order to really get the best terms, we want to look at about a 720. Okay. We do have options for below that. But again, those options are going to be very limited. And they're typically going to have other terms that we have to meet as well. So again, that 680, 720, those are the kind of two thresholds that we're looking at with these DSCR loans. If you are not sure whether that property is going to cash flow, definitely recommend learning how to do your numbers. Greg does that class. So you could definitely jump onto that class on this platform for that as well. Again, this DSCR loan is very much going to be property focused. So we do have to do an appraisal. And we do have to typically, on most of these loans, not all, do a rent appraisal as well. So see, what is the market rent in your area? And that's how the lender is going to determine what your expected rent is going to be, unless there's already a lease in place. If there's already a lease in place, then we can also use that as well. And we can even do these on short-term rentals as well. We'd be able to pull that information from AirDNA or the lender's choice of short-term rental estimator. And we can actually do DSCR loans with short-term rentals as well. Any questions on this? I see.
I do have a question. What about down payment?
Down payments, yes. So for these, you're going to be looking at about typically between 25 and 30% is going to be most common what you would be putting down for a DSCR loan. We do, again, have options that are going to be less than that, as little as 15%. That 50% is typically going to be for an investor who has experience and a good credit score. But for the majority, you're going to be looking at 25 to 30%. Again, options for below that, but they're just not as plentiful, and they're typically going to require that higher credit score or experience or a combination of both, depending on the lender.
And is that an out-of-pocket cost as well?
What do you mean by that? Like the down payment?
Correct.
Yes. So you would have to have the funds for that down payment. For these loans, you can have those funds in a business account. You can have those funds in your personal account. You can go into a DSCR loan with someone. So if you are, pooling capital, we can do it where we're putting the capital into an LLC for the property. And there's ways for us to do that as well, where if it's not just one person that's putting money towards that down payment, we can arrange for that. And again, with these loans, it's very bank specific. So the way we do that actually depends on the lender that we are using, which is why it's really important to, if you are pooling funds, to talk to your lender first, call me first, because we will need to kind of look and see where it's going to determine what's the best way and what's the best place to put that money, and whether it needs to be seasoned, so whether it needs to be in your account for a certain period of time, or whether it's okay that, it's put in, 2 weeks before closing or whatever it might be.
Awesome.
What other question?
That's it.
All right. So in addition to that DSCR, again, that DSCR loan is going to be our most popular investment loan. We also have these alternative income loans. So these loans, you can actually use these loans both for investments and for primary residence as well. But these loans are going to be going back to income-based loans. The difference with these is this is for people who might not be able to show their income in a traditional way. So think business owners, 1099, someone who is someone who might be, have multiple streams of income, and or maybe income that isn't seasoned. So they have a business that's doing well, but they haven't been in business for the full 2 years that you would need for a conventional loan. So for these loans, again, we are still calculating income. We're just calculating it differently. So for the P&L loan, we're looking at your profit and loss statement. You will have to have that certified by a bookkeeper, a CPA, or an accountant. Again, that does depend on which lender we are working with, what options we have in terms of getting that signed off. But we're looking at your P&L, and we're going to use that as your income. For 1099 loans, same thing. If you're getting a 1099, and then with these two loans specifically for people who write off a lot. So these are good if you're writing off a lot. So on your taxes, your income is low, but that money is in fact coming in, and we can show that money's coming in. For the bank statement loan, we're going to be looking at the deposits that are coming into the bank account. And so we look at those deposits over a period of time, typically 12 to 24 months. And that's going to be, those deposits are going to be added up and divided, and that's going to give us your average income for that year or for that 24-month span of time. And typically that's divided by a percentage, oftentimes somewhere around the 40 to 50% range, again, depending on the lender that we're going to. And that is how they're going to calculate your income. Okay. With these loans, depending if it's an investment loan, you're still going to be looking at that 20 to 30% down payment range. And if you are doing it for a primary residence, again, sometimes it can be closer to that 15%, but it does depend on the lender. And it's also going to depend on you specifically, what that down payment is going to need to be. But typically that 15 to 30% range is going to be where we're going to be looking at for the down payment. And those down payments, if you want to set up a consultation, I can give you kind of a smaller, narrower range depending on your situation, your credit score, and your financial situation, and the type of loan that you're looking to get. Again, these loans are great for those who are business owners who are writing off a lot on their taxes, and your income on your taxes is not showing as much as you might actually be bringing in because you're writing a lot off.
Right.
Questions on
No.
these P&L, 1099 loans, bank statement loans, what they're good for, how it might help you, how you might be able to utilize them?
I'm good.
All right. So For most of the loans that we've talked about, you're going to be using those for your long-term strategies. So for your rent and hold strategies, your short-term rental strategies. Now, for these that we're going to talk about now, these are some of the options that you want to consider if you are not planning on holding the property as long, or if we have an exit strategy, we know we're going to refinance into a different type of loan or things like that. So the interest only loan is what it sounds like. It is not amortized over, the typical 30 years. You're going to pay interest only, and there's two kinds. One is going to be where you only pay interest, and at the end of that period, it could be 2 years, it could be 5 years, it could be 1 year. At the end of that loan, at the end of that period, your loan is due in full. Okay, so think of this, a lot of times this is the type of loan that we use for your fix and flip loan. So we might pay interest only because we know we're going to sell that property before a certain time, and then the rest of that loan will become due once you've sold the property. This can also be used if, for example, we know we have a lot of renovations to do on a property where we might be able to do some of those renovations and then refinance it later based on its higher value after it's renovated. The other one is going to be where it's interest only for a period of time and then it amortizes after that. So those types of loans are available where it's interest only for a period, but then it's going to amortize after that. ARM loans, so adjustable rate mortgages, these are something that people are typically more familiar with because we do use them on the conventional side as well. They are also available with investment loans where it's an adjustable rate. So it's going to go based on the prime rate, and how often the rate is going to be adjusted based on prime interest rate depends on the loan. Okay, so it does depend on the loan. And once we get into those strategies, we'll actually be able to see what the different options are. Some of them might change every 6 months. Some of them might change every 3 months. But there's all different kinds of ways that rates at which that rate can change. Oftentimes you're going to have a slightly lower rate if you do an ARM, but you have the risk of it raising depending on how the interest rate environment moves. And it can move up or down. The other one is going to be a hard money loan. So this is where you're not using your traditional lender. You're typically using either a smaller company or an individual that's going to give you this money. And this loan is a little bit wild, wild west. It depends on what that person wants in order to secure your loan. Some of them want just as much as some of the traditional lenders do, and some of them, just want to make sure that you have experience or that the property is good collateral. It just depends on what they want, but they're typically going to charge a significantly higher interest rate than what you would get with a more traditional lender. Now, with these, we do have connections. We do have people who do these loans. And if that's something that you're interested in, we're happy to connect you with one of our hard money lenders. But typically your hard money loans are going to be either part of your strategy from the beginning, or they're going to be a last resort because, for some reason we're having trouble getting you a more traditional loan. And I put this under the short term because typically they're going to be shorter loans. Not always, but typically these types of loans are going to be shorter term loans. Again, these are going to be for your shorter term strategies, your fix and flips, heavy renovation properties, or if we have a plan to get into a property and then refinance later. Any questions here? All right. So some of the less common types of loans, the first one is going to be delayed financing. I actually really like delayed financing. I think they're a really cool loan. Basically what it's used for is if you plan on, or if you need to purchase a property cash, but you don't want to stick with the cash strategy. So let's say, for example, you have a property and you're competing and you agree, hey, we're going to close on this cash to get it done quickly. Maybe, it's a really tight timeline, or maybe the seller is just looking at cash only deals. You can actually purchase the property cash, and on the back end, we can pretty much refinance that property very quickly in order to get you cash back from that property. And then you have your loan on that property. So pretty much it's kind of like if we need to do a two-step process to get you into that investment property. We can do this, like we can literally, do this and be doing this process while you're purchasing, while you're going through your cash purchase. So as soon as you close on your cash purchase, we can move this forward and get you closed pretty quickly after you actually do that cash purchase. And this is designed to not have the seasoning period that a traditional refinance has. So a lot of times you might have to wait up to 6 months in order to be able to refinance. This can be done literally, within the weeks after you close cash on the property. And if you're going to do this, I like to talk to you before you purchase and before you pay. This way we can have our plan ready to go and get you that cash, get you that money, get that loan in place as quickly as possible after you pay that cash. So this way you are not out of your cash too long. So yeah, I think that's a really cool option that not a lot of people realize. Basically, it's similar to the refinance strategy. We're just able to do it a lot quicker than a traditional refinance. And the other is going to be a portfolio loan. These are not very popular right now. Reason being is just because the market is not upholding them right now. So we do still have some available, but this is going to be for those who right now in today's market, February 2025, for those who are, looking at bundling 8 properties or more. We've seen it in the past where you've been able to bundle 3 or 4 or 5 properties. Right now, just with the way the market is, it's better to do those individually than to bundle them into a portfolio loan. But if we're looking at, again, 8, 9, 10 properties, then this is an option that we should definitely at least consider and look into. And again, depending on how the market changes, these might become more popular. They might kind of come back as we have market fluctuations in the future. So it's something to keep in mind and definitely to ask about. But again, they're not the most popular in today's market right now. What questions do you guys have about this type of loan, about these less common loans, delay financing, portfolio loans? Any questions on those?
I do have a quick question. When you delayed financing and you refi, is there a percentage that you can refi?
Yeah, so for the percentage to refi, again, it's going to depend on credit score. It's going to depend on the lender that we're going to, but you're typically looking, again, in that 25-30% range. Again, unless you have experience or kind of a, experience or a higher credit score, we might be able to get that LTV a little bit higher, but typically you're looking at 25 to 30% for most people. All right, so loan qualification requirements. One of the things that I like to tell people is this is kind of like a game, right? Really, the game is proving to the lender that you can pay. And my job is to help craft that story. So with non-QM loans, it's pretty set in stone. There are certain requirements. We have to meet certain thresholds. We have to put it through a system to see, hey, is this person going to qualify? And we're going to pretty much, for the most part, get yes, no answers. When it comes to the non-QM stuff, it's a little bit less black and white. We really have to look at the lender to see what's important to them, and they weight things differently. They weight things differently depending on the type of loan, and they weight things differently just depending on the lender that we're choosing. And also with the non-QM loans, it's more common for us to be able to get exceptions. So if there is a reason, so let's say one of these things on this list you have more of than what's expected, then we can use that to say, hey, can we get an exception in another area that maybe we're a little bit low on. So for example, if we're doing a DSCR loan and we're a little bit shy on cash flow, if you have a lot of capital, we might be able to override that cash flow requirement and get an exception from the lender that we can still do that loan. That's something that we can do on the non-QM side. And having someone like myself helps because I'm able to go to them and I'm able to ask those questions before we put your loan in, so that we can get answers on that and we know how they're going to handle different things before we even submit your loan to that lender. So when we're looking at loan qualification requirements, first thing is going to be credit score. If we're doing QM loans, VA, we can go down to honestly 520, 530. Obviously, it's not going to be a 0 down loan at those scores, but we can go pretty low on the credit score with those. Even with FHA, we can get them through lower than 580 in some cases. Again, it's not going to be at the 3.5% down payment, but we can still get those through at 580. We can get those through pretty easily. Again, as long as you have the income and DTI. Liquid capital. So for all of these loans, there has to be some funds in your bank account. Now, how much depends greatly on what type of loan we use, but you typically need to have the down payment and closing costs. We have to show the lender that you have those funds available in an account ready to go. And we have to do that before we're able to close on these loans. And I'm going to double check before we even get into those, get into submitting your loan, that we have what we need, so that when we get to the end of the line, we're all sure that we have, again, the liquid capital that's needed. And that's going to depend on your loan. Your debt to income ratio, this is going to be for those government-backed loans, because we're going to pull your credit and we're actually going to look not just at your credit score, but also at how much your payments are in comparison to your income. And then the property, we're going to be looking at the property. Now, again, how much we're looking at the property or what we're looking at with the property is going to depend on the type of loan. So if we're looking at a DSCR loan, we're looking at the cash flow. If we're doing an FHA loan or a VA loan, we're looking at the property to say, hey, is this property livable? Is it, up to code? Are there any repairs that have to get done on this property? And then we're also going to be looking at experience for these investment loans. We can do loans for those who have no experience. We can do DSCR loans for those who have no property, who have not purchased their first home yet. But the more experience you have, the more leniency we get in terms of criteria, in order to get the loans approved, and also in terms of your rate. I have some lenders that only work with investors that have experience. So if you have more experience, you're going to have more options in terms of who we can go to for your loan, and how much competition there is, and again on that rate as well. What questions do you guys have in terms of qualifications? It could be for any of the types of loans that we talked about today.
All right, I got a question. Reserves on the bottom, you put reserves?
Yep, so that was in liquid capital. So yeah, sometimes you do have to have those reserves as well. So you have to have a little bit extra. Again, that's going to depend on the loan. For some of the DSCR loans, which are going to be that most unpopular investment loans, some of them require no reserves, and some of them require 3 months, 4 months, 2 months reserves. It just depends on the lender. But we do have some that just want to know that you have the closing costs and enough, your closing costs and your down payment. But again, for most of them, you're going to need a few months reserve, so a few months of your payments, and that just depends on the loan and again your credit score as well. Brian,
is probably a dumb question, but the graphic, is that a rating?
No, it's not a rating. It's
a
just
scale
of
importance from 1 to 5.
Yeah, no, it's not in any true order.
Okay.
I'll say every single one is going to look at credit score. Every single one of these loans looks at your credit score. Every single one, you have to have some liquid capital. How much depends on the loan. And then the other 3, it really just depends on the type of loan that we're going for. But the first 2 are pretty accurate, but the rest we're not in any particular order.
Okay, so
I have a question.
I just wanted to make sure those bars weren't a level.
No. It was just to make it pretty.
Okay, all right. It was just graphics. All right, thank you.
I have a question.
Yeah.
So I'm 25 years old. I make so money. My credit score isn't that deep. I mean, it's decent, but it's not as like you normally would see as someone that's like 10 years older than me, 20 years older than me. How do people with my age kind of get like qualified for like investment loans and stuff like that?
Yeah, absolutely. So it's really going to depend on why your credit score is where it's at. So if it's a matter of you have really good payment history, but you just don't have a lot of time in your account, it's just about making sure that those payments are on time, making sure that we're adding time, maybe making sure that we're diversifying the types of accounts that you have. If there's, so it really depends on why your credit score is where it's at. There are different strategies for raising it, but I would say, some of the things that you can do, again, just depending on where it's at. If it's close to some of these thresholds, if you're close to like that 680, then we can do a loan, right? We can get a
I
loan.
mean,
We
it's
can get a loan.
720.
Sorry?
720 is my score.
So yeah, you're in the threshold. You're not in a threshold that we can't do a loan for you. So based on your credit score, yeah, we could definitely get this type of, these investment loans closed for you.
Do you get any benefits from like being young and doing it, or does it not really matter?
No, not any benefits from being young. Really, especially when you're looking at the investment loans, they don't care about your age. They care about your experience. So they care about your experience and are you credible? And so we're looking at your payment history, of course, your credit score. We're looking at the property that you choose. Is it going to cash flow? But they're not concerned. They're not concerned about your age. I mean, whether you're
Understood.
25 or 65, if
Understood.
your profile is showing the same thing, it's going to be what your profile is showing. But your age is not a big factor.
And
Okay,
I,
Sarah,
oh,
that
Yes.
question's coming from my nephew, so I'm gonna answer. Yes, it matters. Get started as soon as possible. The earlier, the better. You don't want to be 65 and just getting your first investment deal. So, absolutely, before you buy that
So
sports
just to
car,
clarify, I'm talking about you being qualified for the loan.
right?
The
I'm
lender
talking
does not
about,
care whether you are
yes, I'm
25 or
talking to
65, but it does
investment loan.
matter, like in terms of your ability to grow your portfolio and grow your net worth and grow your income. Yes, it
Correct.
definitely matters in that aspect. But in terms of getting you approved for the loan, they don't care
Right.
how old you are, as long as you are, I mean, 21 and up, they it's all the same to them.
okay. They just want my money.
I'm talking more in reference to, as his uncle, I'm talking more in reference to get started as early as possible. You'd rather be
Yes.
getting started at 21. Everyone on this call, I'm sure that's Josh, that's not your age, will tell you if they had got started, how far they would be by now. So the earlier, the better. Before you buy that first sports car, before you buy whatever it might be, those pair of Jordans that are custom and whatever you might dump your money into.
Exactly.
You buy that first duplex first. You live in one side, you rent out the other, and that's how you build your wealth. So
100%.
the earlier, the better in that reference.
100% agree with that. Yeah, no, I mean, if you're, like I said, if you have a 720, let's set up a consultation. We can actually talk through your finances. Cause like I said, I'm not the type of lender where it's, hey, let's take an application and, if you're not ready today, we're not going to continue to talk. I actually just, was speaking with someone, they're at least a year away from purchasing because they have some work that they need to do. And my job is to keep in contact with them, coach them, make sure they're, make sure that they know what their next steps are, and make sure they know as the landscape changes, if anything that we talked about changes, because it's, things change. The advice that I might give you today, it might be a little bit different in a year. interest rates might be different. The landscape might be different. So that's definitely, I'd love to talk to you and make sure that, we have a game plan to get you into a property as soon as possible. And make sure that first purchase is a strategic one for you.
It's always been a dream of mine to like kind of get ahead of like all the people that are older than me that are doing what I want to be doing like now, if that makes sense. So like yeah, it's always been we definitely have to connect. But yeah, it's definitely been a dream of mine to like, especially since I met Brian, and like learned about more investments and like than just stocks and bonds and stuff like that, like actual like tangible assets. That's kind of like something I've always wanted to do. So yeah, we definitely have to connect.
Absolutely, absolutely. And I saw Brian had a hand up and Miranda had a hand up.
No, you took care of me, Cassandra.
Okay, perfect.
I was just chiming in. Please continue.
What should DTI? Okay, there was a question in the chat, and it was, what should DTI be to qualify for a DSCR loan? They don't care. They don't care about your DTI for a DSCR loan. It's your credit score. So making sure that your credit score is high enough. They do care about, if you've had a recent short sale, if you've had a recent bankruptcy, they do care about things like that on your credit report. But yeah, we're not actually going to be looking at your debt to income ratio for a DSCR loan. We're looking at the cash flow of the property. And is it going to cash flow? And that's going to be based on an appraisal. If there's already a lease in place, or if it's a short-term rental, we'll be using the lender's choice of short-term rental estimator. What other questions? Miranda, I saw you had a hand up. Did I answer your question already?
No, I'm sorry. My internet dropped out, so I had to
No
come back in. So first, congratulations. I love seeing you teach tonight. You're amazing.
Thank you.
So I was listening to, I'm sorry, I had a little bit of feedback here, but I was listening to Joshua. He was mentioning what his credit score was in the 720. And I do know a lot of times, and which I did it for my girls as well, that I used how I got their credit scores out was by adding them as an authorized user. And that authorized user, a lot of times when they go buy a property or when they go buy something, they can tell, okay, that's an authorized user card. And so I had to go and diversify their credit. So add other lines on there so that they could see that. So I didn't know if that was something that would also, that is applicable when it comes to the types of mortgages that you're mentioning. I know when she went to buy a house, they did want to see another trade line on there because they could tell that it was, her score was like a 740, but it still mattered because it was due to that adding her as an authorized user.
So just to clarify, is the question whether that's a good strategy for these investment loans as well? Is that what you're asking?
Well, the question is, does diversity matter on that score for someone that like as an age, if it was, because I don't know how the score got to a 720. Yeah. Sometimes if it was because it was authorized user, they want more.
Yeah. So if there's very little, then yes. It's almost like if there's very little on there, then yes, they can ask for more. But if you're in the average range of credit lines, then having an extra one, unless it's boosting your credit score, isn't really going to help much. So if you have very few credit lines, then yes, that strategy is going to be a good strategy to diversify. Again, depending on the timeline, there are other ways to diversify, even if you're not on someone else's, even if you're not an authorized user. Right. So there are multiple ways to diversify. That is definitely an option. But yes, if there's very, very little, then yes, that can come into play. But if you're, in the average range, then no, it's not going to be much of, specifically on those DSCR loans, it's not going to affect you too much.
That was my question with the DSCR. Yeah. Okay.
So in other words, it can on the low end, but average to high range of credit lines, it's not going to affect you too much.
Perfect. Thank you.
Of course. What else? Any other questions? All right. So just some tips for success here. We want to make sure that the strategy that you are using matches the loan that we are placing you with. Okay. So if you're doing a fix and flip loan, we need to be, using a loan that matches that strategy. If you're going to buy and hold, we want to be using a loan that's going to match that strategy. If you are planning to purchase lots of properties this year, we want to use strategies that are going to match that strategy. So your strategy does matter when choosing the type of loan that we are looking to use for you. In addition to, of course, your finances and what you are, where you're at financially, and what we're looking to put down as well. We also want to look at market conditions. Things do fluctuate. Like I said, with those portfolio loans, they were more popular at one point, less popular right now, just because the market changes. So you do want to, I suggest anybody who's looking to get into investing, find some investment platforms, find some investment podcasts, find an investment group. You want to be hearing about the market, about the real estate market, about the mortgage market, about the investment market. You want to be hearing the information so that you can kind of just stay on top of the market conditions so you know what to expect. We see this happen with people who not necessarily who are in the investment world, because investors tend to be more tuned to what's happening in the markets, but we see it a lot with more so people who are looking for their primary, who, oh, well, I thought this is what it was. It was 5 years ago. Things change. So make sure that you guys are getting up-to-date information and staying attuned to what's going on in the real estate market. And we do want to make sure, again, we are up to date with what's going on so that we can match those strategies. And you want to work with a knowledgeable lender that has options. You want to work with somebody who has options for you. Being flexible has its benefits, and you not having to go and do another entire application when the market changes, because sometimes it might take you, a couple months to find the property from the time that we talk about what you're approved for. Well, in that 2 months, we could be looking at, again, 2 totally different lenders for what's best for that same strategy. Or maybe your strategy changed. Maybe you were planning on buying a $300,000 property, but hey, a great property came by and it's only $125,000. Well, guess what? Not every lender who does $300,000 loans will do $125,000 loans. So we might have to adjust. And with us, we're able to do all of that behind the scenes so that you're not doing it. You're not doing another application. We're just, collecting any additional information that we might need to get your application updated. And we're going through and we're saying, hey, I have this guy. This is the situation. This is the loan application. Where's the best place going to be? And I'm also able to go to lenders and say, hey, I have a situation that's not in your guidelines. Can you tell me how you're going to deal with this? Just like the trade line question. Like if we say, hey, look, we think this might be an issue, I can actually go to the lenders beforehand and say, hey, look, is this an issue for you? Because especially on the non-QM side, one lender might say, I don't care. And one lender might care a little bit, So we don't, with those, we want to make sure that we're addressing as much of that as upfront as possible. And we're able to do that and then adjust what lender we are going to as things change for you guys. I can't see my mouse for some reason. It's here on one of these screens. There we go. And so that is pretty much it for us. Oh, one more thing. So things to avoid. We kind of talked about this already with the tips, but we want to make sure that you guys are, having accurate cash flow estimations, especially with any investment. With any investment, you need to know your cash flow estimations, but especially with that DSCR in terms of getting qualified for it, we do need to have accurate information as far as what you think you can get for rents and things like that. And so again, this platform is a great place to go and learn about that. You also want to know about the hidden costs. I will tell you this, not every loan officer is the same. Okay. We are not all made, we do not all operate exactly the same. I think most loan officers want to do, are here for good, but there are those who, and I've seen it because I've seen the loan estimates that hide costs or, underestimate costs or, try and finagle things in a way that's, I don't think is the most ethical or is the most honest. But so you do want to make sure that you understand the fees. You want to make sure that you know what your appraisal costs are going to be, because especially on the investment side, they can range. If it's going to be different if we're doing a 4-unit property, it's going to be different if we're doing a condo, it's going to be different if we need to add on that rent appraisal as well. So you want to know kind of what those fees are going to be and ask the questions. So if you guys get a loan estimate from me and you don't know what a cost is, ask me so I can tell you, and I will tell you what makes up that line item, and we can discuss it. And then also poor understanding of the terms. You want to know, we didn't talk too much about prepayment penalties. Those are something that you want to be aware of before you go into a loan. So at what point, how many prepayment penalties is if you pay off your loan before this point, there is a penalty. Okay. And this protects the lenders so that they get enough interest in order to make it worthwhile to do your loan. So you do want to know what are those prepayment penalties on that loan? What is the prepayment penalty if you do end up paying it off early, which is also where we want to make sure that the strategy matches the loan that we choose. But go to someone who, if it's not going to be me, I hope it's going to be me that you choose, that you reach out to. But if it's not me, make sure that you are asking the questions and that you are, any loan officer should be giving you full and total information, especially when they're looking at your particular finances. And we're talking about the loans that we're looking at choosing for you. So just make sure you have a good understanding when it comes to your money. There are no stupid questions, because at the end of the day, it is your money. So there are no stupid questions when it comes to this. It is a big, it's a big investment. Anybody who's investing in property, these are not small investments. These are big investments. So we want to make sure that we understand what's going on with the loan. And from there, that is the end. I'm going to stay on. If you guys have any questions, please go ahead and ask them now. Or if you want to set up a consultation with me, you can go to my website, ksarahhomelending.com, and you can set up a consultation. You can also call me or text me at this number. Again, I'm not available. It's not just 9 to 5. So if it's 6 o'clock and you have a question, go ahead and give me a call. If it's 7:30, go ahead and give me a call or shoot me a text. And I'm happy to help you guys. Again, no matter what stage you are in the process, looking to be a resource for you and get you guys to that finish line. If you are looking at doing an investment loan, within the next few months, let's go ahead and take a look at those financials, see what strategy we think is best so that we can start working towards that plan. I highly recommend you not wait till, the month before you think you're ready. Let's talk 3 months out. This way we can identify any obstacles that need to be cleared up, or make sure that we know, hey, how much we're going to need for the down payment, depending on your financial situation and the type of loan that we're looking at. And Brian, I see that you have a hand up. Is that a new hand up, or was that?
Yeah, I just wanted to mention that we will be attaching your profile to the underwriting, our deal analysis underwriting platform. So when individuals are underwriting deals, they can request a quote from you. And so you can send those financials. Those financials will be sent from the deal underwriting platform directly to you, so you can get a quote in real time.
Yes. So I'm excited to work with all of you guys. I see Terrence came on screen. Did you have a question, Terrence?
Yes, I wanted to know, was there like a minimum loan, a minimum amount that you loan? Or?
Yeah, so typically the minimum is going to be, so again, it depends on with these loans, and hear me say it a lot, it depends on the lender. 125 is typically on the low end. We do have some that will go down to 100,000. So once we get under $150,000 for the loan, our options become more limited. Just
Okay.
banks want to lend a lot of money and get a lot of interest. We do have options for those. It's just 150. You have lots of options. 150 and up, we got lots of options on the investment loan side. Once we get below that, we have less options. We still have good options. I have some really good lenders that work in that range. Once we get under 100,000, it becomes difficult.
Okay.
Does that affect the rate when it's a lower loan amount like that?
It can, yes. So some lenders will add on a little bit to your rate because it's a lower amount. Yeah. So there's multiple things that they can add on for your rate. Like if we need an exception for something, that would add on to your rate. If we have a lower loan amount, that will affect your rate. But that's why we get to shop for you. I had someone a few months ago who had a lower loan amount, and I mean, even with adding on, because it was a condo, it was a non-warrantable condo, and it was a low loan amount. Because of the lender we went to, it was still less with all of those penalties than the next best, even without them having added on all those penalties. So don't be scared away by me saying, hey, it might add on to your rate, because sometimes it's a very small amount that it's adding on. And if it's a good cash flowing deal, it's still going to cash flow. It's not a matter of does it add on a little bit to your rate. It's, hey, is this going to cash flow with all of this once we add it all in? And again, that just depends on the situation. But don't let that scare you away. It does, but it's not like it's adding on a whole percentage or anything like that. It's not even close to that. It's adding on just a little bit.
I have another question. Do you do 203K loans?
Yeah, so we do all types of loans. So that's one of the things that we can pretty much do almost any type of loan. The only loans that we get limited on are if it's commercial, but it's not like we can do like a small hotel, we can do a small apartment building. Pretty much if people sleep in it, we can do it. If it's like you're going to be using that it's a commercial space for a spa, it becomes a little bit more difficult depending on how you're doing it. Unless you're buying something that's, both residential and commercial, it's got both classifications, then, sometimes we can do those types of things. But yeah, so we can do, like I said, we do VA loans, we do the 203K loans, we do rehab loans, and we also, if you're looking for that primary residence, we do work with BPA programs, we do have a number of lenders that also do have in-house DPA programs if you're looking for that primary residence, first-time home buyer type thing. So we do it all. And if there is something that especially with the VA loans, we do have someone who works with us who is knows the VA code in and out. So we have people on our team, even if it's something that I haven't handled as much, we've got somebody who's ready to make sure that everything goes smoothly. And that's the benefit of having a team. It's me, but it's not just me. We have a whole team behind us that's making sure that these loans go smoothly, and that makes sure that you guys are getting the best experience.
All righty then.
I see Johan. I'm not seeing your full name. I'm sorry.
No worries. It's Joe Angel. How you doing?
Joe Angel. Sorry about that.
That's all good. Hey, I got on the call a little bit later, so I'm not sure if you addressed this, but I did have a question regarding. So just to give you a little bit of background, really quick. I'm first time investor trying to get into my first property. I did open an LLC locally in Florida, and then a holding company in Wyoming. Do I have to start out with a loan that's under my name, or that I could eventually flip over to the LLC, or can I purchase with the LLC
Still going.
in the loan?
What's going on?
Yes, so we can.
Sign off.
The way I would
after.
describe it is you can. Oh, go ahead. Sorry, Greg.
Oh, sorry. I didn't know I was on mute.
It's okay. So
I was
we will
talking
be
to
able
Karen.
close in your LLC's name. So pretty much what we'll do is it's still going to be your credit score. They're still going to look at your financials. Again, depending on the type of loan it is, but but we can close in the name of your LLC without you having to switch it later. Now, if there's a reason for us to close in your name, if there's, you know, which especially if we're doing a DSCR loan, I don't necessarily, there's not really any benefit to doing that. But let's say, for example, you were doing more so like a government loan where we need to close in your name, and then, you know, 2 years later you want to do that or something like that, you can do that. But when it comes to these investment loans, no, almost all of them you can close directly in an LLC.
Okay, perfect.
And you don't have to have that LLC for a long period of time. I literally had someone, we created the LLC for them like after we had already submitted the loan. So as long as all the paperwork gets through, that's what matters. So it doesn't have to, you don't have to have an LLC for a year, like it could be 3 days old and we can still close an LLC.
All right, sounds good. Thank you.
Now I have a question, Cassara. Going back to the short-term loans, that type 2 one, the interest only, where you can amortize later. What's generally the period of time where the amortization starts? Yeah, or is it just? It
depends. I don't want to give you an answer off the top of my head just because we don't really use them that often. Because usually if we're doing a fix and flip, we typically are doing, you know, again, that, you know, we're choosing that 24 to, you know, 12-month loan. So I don't do it often, but I can give you that information. I want to give you accurate information. I don't want to go off the top of my head because I don't do those too often. We don't, it's just not, it's not a popular choice. Again, it's available, but it's not a popular choice. But I'll get that for you, Greg. What other questions do you guys have? All right, well then, it's 7:07. We ended pretty much on time. So yes, I'm always glad for making sure that we I'm always glad to make sure that we respect everyone's time and that we finish on time. But if there are any other questions, please feel free